one of the big trends that has really set the stage for this industry this year is both the digitization of things, the going from analog to digital, as well as the digitalization of things, which is just digital tech taking over the world. Try and saying those words fast. We are going to see how these trends, which had been in place for a long time, but really accelerated in 2020 because of the pandemic, because suddenly we have to all do things remotely, how that has impacted first the ETF business specifically, the industry. So I want to start with you, Anita. You are, head of capital markets desk at WisdomTree, a big issuer. From your perspective, from the issuer side of the business, how has just the digital nature of everything impacted how you guys go about evaluating products, launching products, doing day-to-day activities? What's significant to you?
Well, firstly, I think that the digital impact has changed our whole lives this year. But as far as specifically in ETFs and specifically in our world, last year and this year, I think what we're seeing the most is an evolution in where our ETFs are consumed. So as technology advances, singular ETFs are becoming more available on different types of platforms, reaching all sorts of different users that we as issuers need to be connected to. And now ETFs are not only being consumed as singular ETFs, but also as models of ETFs. So ETFs are now widely available, like I said, in ETF models. So not only the individual strategies, not only are these individual strategies available in these cost and tax efficient wrappers, but now the models offer the professional asset allocation and diversification strategies at a fraction of the cost. So this is in essence a new distribution channel. And as an ETF issuer, we have to be at the forefront of recognizing that. We have to be partnering with all of those platforms that are accommodating the users. And at the end of the day, all of this technology is really making it good to be the investor.
Mm-hmm. Reggie, from where you sit at GTS, and you guys are involved with the day-to-day trading activity, and I can't imagine there's still a lot of pen to paper in your side of the business. It's been high digital from the beginning. Is there anything that's notable in this, acceleration of these trends in 2020 on your business?
Well, I think there are a couple of key trends here. The expansion of the industry through active managers launching active ETFs using various structures is growing. And I think that we'll see an expansion of new entrants in the marketplace. We saw it this year. We'll definitely see it going to 21 and beyond. So I think you'll see an expansion of the ecosystem. That's a positive thing. And then largely, new regulations is also going to allow the growth of leverage and inverse leverage ETFs. So I think you'll see different strategies come out from that segment of the marketplace. And then finally, I see a lot of adoption of equity derivatives inside of the 40X structure. So whether it's buffered ETFs or covered calls or various strategies. So I think you'll see an explosion of instruments that have a lot of interesting developments, and they're very complex vehicles that need to be understood how to use. So I think advisors and retail investors, or all investors, have an opportunity for exposure to these products. Education is pretty important around them. And even some of the growth in some of the less liquid cycles like CLOs came out in 2020. So I think you're still seeing innovation occur. And we see that as a market maker. We see our clients launch these products, and it's just good opportunity for additional growth.
I'd love to, Rick, I think you're muted. So I would love the advisor perspective. It's always exciting from the industry side to talk about the new products that are coming, the new areas we can explore. Like Reggie said, active management. We have the non-transparent or semi-transparent wrappers now, different areas we can, access maybe better, maybe in more novel ways. In the advisory channel, are these tools that you guys are looking for? Is this something that investors are demanding, or is this just product innovation for the sake of product innovation?
Okay, as an advisor, I don't see clients demanding things. Basically, it's the advisor who looks at something that's been created and makes a determination whether or not it's good for the client. So it's sort of one way, it's pushed down from the advisor to the clients as opposed to coming up from the clients. In the 32 years I've been an advisor, very rarely does a client say, hey, I want this, I want that. Why doesn't it exist? It's usually the advisors who are saying, clients need this, clients need that, go create it. And I think that with the, what Anita said, with the new realization, I've seen it coming for many, many years, but the new realization that individuals are going directly to the ETF marketplace, bypassing advisors, bypassing brokerage firms, going direct to the ETF providers is a huge monumental shift in what is happening out there. Individuals are now no longer afraid of buying ETFs directly. They're beginning to get it. They're beginning to understand it. Maybe they don't understand things like why bond ETFs go down in value during a market crash while mutual funds that have the same bonds in them don't go down. That was kind of a mystery. But by and large, I'm finding that individual investors are not afraid of ETFs anymore. They're adopting them. They're looking at them as part of the whole package. And this is a huge market to go direct. I look at it just like back in the 1970s when the first no-load mutual funds came out, and people were going direct to the fund companies and starting to buy directly from the fund companies using no-load mutual funds. The same thing is happening in the ETF marketplace now. It's a huge market, and it's driven by the internet. People are able to get more information on these things and learn more about them from podcasts like this. And so that's a huge change, a huge shift, I believe.
Reggie, from your perspective, this phenomenon, which is one of the disruptive phenomenons in ETFs, which is this direct to retail movement, what are the market making implications here? Is there anything to be concerned if you start to just get, folks coming out from everywhere, just buying their ETFs directly online? Is there, beyond just the educational aspect of it, making sure that if people know what they're doing, especially when you deal with more complex products, but anything that we need to be conscious about?
Well, I think through competition, the retail platforms have offered fractional share trading of equities, which include ETFs. That's a positive thing. No commission or free trading on the platforms, retail investors. That just makes market access achievable for all types of investors. So that's positive, and that's a good thing. And in terms of the various products that are offered, self-directed investors, they're typically pretty smart people. I think that we get into some complexity. There's some nuance that has to be, I think, understood and channeled. But by and large, investors want to have access to what they want to buy. ETFs have allowed that. If you think about the first commodity ETF or the gold ETF, before you had to call some expensive broker and pay a surcharge in order to buy gold bullion or coins. Now you can buy fractional exposure to gold and do it in a cheap and expensive way. So I look at this as the access into the marketplace as beneficial and competitive and good for younger investors. And I think the ETF community is allowing for capitalism to work for all types of investors, and ETF are just one of the tools that are using that.
Anita, do you see any challenges from the issuer perspective on this move straight to retail? I mean, I think Rick and I talked in the past about, the concern about messaging. Maybe messaging is different when you're dealing with a different audience that's not going through an advisor necessarily. How do you reach that segment? How do you grow in that space from the issuer perspective?
Well, I mean, I don't think it's a challenge as much as an exciting new opportunity. It's definitely a new group, right? So to your point, though, you have to change your message. You have to change how you're selling it. And that's marketing and sales. And we're surely adapting to that. But, there's stuff that goes on behind the scenes to make it as viable as possible. So I couldn't agree more with Reggie in the respect that, I think ETFs as a tool in general made access first to advisors incredibly democratic, and now to retail. But behind the scenes, you have to make sure that all the infrastructure is, or all the wheels are greased, let's say. And so as an issuer, we're going to the likes of Reggie and GTS and his firm and other market makers and making sure that they're there ready to take on the flow that's coming from these different pipes and avenues. And we're doing that, as well as creating partnerships, like I said before, with the new retail channels and the retail brokerages that are now offering the world essentially for free at a retail investors' fingertips.
I wanted to go back to the conversation about model portfolios briefly, and is just this notion that, you know, the ETF business more and more gets commoditized. And I have heard before just some concern about just too many model portfolios popping out everywhere. You know, how do you get through it? How do you find what you're looking for? I mean, where is the opportunity in model portfolios as true asset growth, and also through true improvement of investor outcomes through the model portfolio and ETFs? Anita, we can start with you.
Well, I mean, I don't think they're commodities as much as, I mean, ETFs are tools, and then the models are a strategic collection of those tools. But yes, I agree with you. There are a lot of different ETFs out there, and thus the permutations of how to assemble them are vast and furious, right? So how do you sort through that? I mean, and again, it's education and marketing and differentiation. And you have to think about what the customer or the investor, meaning either the retail investor or the advisor, wants. And so at WisdomTree, we've always taken a holistic view of our offerings. And if we can put a WisdomTree twist on a sector or an asset class, we'll surely do so. But while we want to have our ETFs and our strategies represented in every sleeve, we do recognize that there are areas that actually we don't want to compete. For instance, single digit beta. So we've gone through the exercise and decided to keep our models open architecture, which we think our investors not only want diversified holdings, but they want diversified managers. So I think it's the more options that there are, the more responsibility there is for investors to do due diligence, and then the more opportunity ETF issuers have to create an easier sense of diligence.
Now, Reggie, I wanted to ask about regulation. I mean, ideas are great, but they gotta get the okay in order to become reality. So the SEC has been really active lately. I mean, we had the ETF rule pass, you know, late last year, get implemented. So much fanfare went around the whole custom basket issue. We had the leverage ETFs ruling. We had the 13F filing proposition that didn't go through. From the regulatory perspective, do you still see a lot of any significant barriers to disrupting or improving the way things are done? Or do you think this is a friendly environment to really create new things and improve asset management in general?
Well, I think you see the willingness of the regulators to flatten the playing field and allow for competition to come in the marketplace, and to remove some of the financial burdens, what it costs to bring an ETF to the marketplace. And the end result will benefit investors in spread and expense ratio and administration costs. So these are all good things. And I think that you're also seeing a comfort level of the regulators understanding the ETF community and what ETFs do, and a maturing of the regulatory burdens that were once illustrated. So all these things are positive, in my opinion. And then even, the wonky things around how accretion baskets are designed and what it takes to launch, all that I think is being competitive. And I also predict that with the change in administration, we may even see a digital coin ETF, sometime in the near distant future, just because I think, some of the elements are starting to be addressed of concern, and a new commission and commissioner may actually want to push this through. So I think the regulatory burdens are lessening, but refocused in other areas. And the empirical data that the 30 years that ETFs have given the regulators have now given an outcome that says that they're comfortable with what they're approving. So I think we're in a good place.
Rick, what do you think in terms of the environment for advisors and asset management when it comes to any kind of roadblocks or regulatory hurdles you guys have to jump to stay competitive, to do your job well? Anything there that we could do better, could see done better?
Well, there's always the question of a fiduciary rule, meaning that advisors would have to act as fiduciaries if they're going to advise people on their retirement savings. But if you don't mind, if I'd like to circle back to the model portfolio question that you asked. Okay.
Yeah.
I have a lot of thoughts about model portfolios. I mean, again, model portfolios were developed, I think, by the industry, not so much by the individual investors or needs. Most individual investors do not need a model, should not have a model. They're sort of canned things that people are thrown into sometimes for the sake of streamlining work for the advisor. A real advisor would not use a model, because when you're talking with a client and you're really getting to know that client, you need to customize a portfolio to that particular client. You don't throw them. It really is kind of amateurish, in my opinion, to go out and use a model. You really don't. There's so many good products out there that you could customize something to a client. I mean, that's what being an advisor is. That's why you're advising. If the clients only needed a model, I mean, they could go to a robo-advisor. They get a model all day long. That's not what advisors should be doing. Advisors need to look at much higher level than that, including taxes. Taxes is such a huge issue, and they're getting to be a bigger issue. And I can guarantee you, in the next few years, they're even going to become a bigger issue, particularly for retirees who are trying to do distribution from their retirement funds and trying to figure out all these different places where they're going to get hit with more taxes on Medicare, net investment income tax, different tax levels, long-term capital gain versus 20% versus 15%. And on top of that, another Obamacare tax on top of that. There is so much more that an advisor can do to customize a portfolio to reduce taxes for the clients. And here's where we get into the whole idea of the actively managed ETF. What is the biggest advantage of an actively managed ETF? It reduces taxes. Taxes are the biggest cost to an individual investor. This reduces taxes. And so from an issuer standpoint, a WisdomTree or whomever, the way you market to the individual investors directly is, I can save you a lot of tax dollars. That is such a huge message that would resonate so easily with the direct to the consumer marketplace, and yet I haven't even heard it yet. But it's huge. You look at right now in November, December, how much billions of dollars are being distributed by mutual fund companies in the form of capital gain distributions that clients don't want. They don't want to pay taxes on this money, but they're getting it anyway. Well, what's the solution to that? An ETF. That's the solution.
But
I don't hear anything about it.
I have a question for you. Do you think those retail investors that are going to be the ETF users or that are the ETF users are coming from mutual funds, or are they coming from single stocks? I think our feeling is a lot of...
They're coming from mutual funds. They are... So what I do on a daily basis is I work with individual investors one-on-one, and I do it on an hourly basis. I'm not selling any products. I'm not trying to sell a model portfolio. I'm not selling anything. I just sell my time, and people pay me for my time. They're coming from mutual fund. They do not want these big capital gain distributions at the end of the year. They want to get away from them. And what's stopping them from doing it? Taxes. It's all about taxes. And if I was a WisdomTree, whomever, and I wanted to go after the retail marketplace, I would be emphasizing tax efficiency, and customization. No, that's what I would be doing.
Well, the funny thing is that tax efficiency is one of the biggest things we talk about in ETFs generally. It's like, one of the big benefits from the get-go. I thought we had been talking about it for 27 years now. So I'm not quite.
Yes, it's true. You've been talking to advisors about it. I'm talking about how do you structure the conversation to the retail investor? Honestly, it's a different conversation. It really is. I mean, I understand the tax efficiency of it, where, I, as an advisor, I have been absorbing this for, how long has it been? 20-something years since Spider came out. I mean, when we first discovered, back after Spider was launched, I think it was a Merrill Lynch report that came out in like 1995. Somebody said, oh, look at this. This is a better tax structure. Yes, it was. And it really is, but I really haven't heard it resonated to the general public, what a great tax structure it is.
Yeah, no, it's an interesting point because I think as an industry, we're still, and Anita, you probably can speak better to that, and you too, Reggie, just this idea that issuers, they're still very focused on pitching to the advisory channel. And maybe maybe that's this disruptive idea here, is messaging to a completely different channel that hasn't been the focus up to now. I think a lot of the messaging, the advertising, the efforts are in breaking into that advisory channel, and maybe now that's broadening the horizon, and we go back to the basics. It's all about death and taxes.
I mean, listen, direct to retail is something that we've been talking about for a while. It's a mobilization effort. You have to create, like I said before, the infrastructure, and then work out how to reach them, and then what to say. And to both your points, the messaging is certainly different. Rick, I'll certainly take your points home. They're very well noted that tax efficiency is by and large, I think, one of the number one advantages. I think there are definitely others that we can speak to, but it's an effort. And Cinthia, to your point, it's back to basics, right? It's ETF 101 for those who haven't used it themselves, but may have used it through their advisors or whatnot, and or haven't used them at all. So it's a whole new effort.
Yeah, so we have about 5 minutes here, so I wanted to ask two quick questions. One is, when we talk about digital tech, the digital customer experience, the digital of everything, it's better, it's improvement, it's faster, it's cleaner, it's more efficient. And is there anything, any vestige of the analog world, if you will, that we will miss, that we're gonna, leave behind, and it really was really good for the industry and for asset management and for investors in general? What do you think, Reggie?
Well, I think the ETF industry is very large and vast, with a lot of bright people out there. I don't think we'll leave any child behind, to use a pun. And I think that from the perspective of innovation, I think that there's corners of the consumer life cycle that has yet to be addressed, and particularly directly into banks and into retail banks, and bringing financial services to the banking client in small towns. And ETFs are ripe for that. And so I think there's a penetration in that segment that will occur. And you look at what you carry in your wallets, I think there's innovation ready to be had in payments and the use of money market ETFs. I think there's something to do there. So there's a lot of opportunity, I think, for additional innovation and ideas. And it will come from, some really bright 17-year-olds sitting in someone's basement, brainstorming about ideas and how to collapse, institutions. So I'm bullish. I'm definitely a participant, and I'm an interested party to see it, come to my front door, as ideas pop up.
Any thoughts on that, Anita?
As to what we're leaving behind in the pencil and paper world, you know what? It's interesting. I was thinking about it, and Rick, I think this is something that kind of alludes back to what you were saying, and I think in the pencil and paper days, when a retail person wanted to trade, they had to go through a process. They had to make a phone call. They had to pay a lot of money in commissions, right? Making the access free, easy, and immediate does away with a lot of the time and pause that should be taken with some of these investments. And so I think it's a responsibility now to have a conviction in what you're doing and not trade on emotion. And I think that is where the advisor brings some of the most advantages to the table, right? Not just their expertise and on the investing world, the products, the services, and the strategies, but the disciplined approach to investing. And so when everything's available to you at your fingertips, sometimes you don't take enough time to really think, and you may sell at the lows and buy at the highs. But I think that's just more of a responsibility of the benefit.
Yeah.
Area
Absolutely.
that has yet to be penetrated, but I think it's slowly coming, is the 401k, 403b, 457 market. ETFs are not there. They're not. The only people who really have access to ETFs are people who are in a 401k plan who have a direct brokerage link where they could move out of the options that their employer are giving them, basically the life strategy funds, and moving into the brokerage model. And there, once they're in the brokerage side, the brokerage link side, then they can go ahead and buy whatever they want, and they're buying ETFs over there. So it is a way for the 401k participant to actually get into ETFs. But other than that, very difficult for them to access the ETF marketplace. I think also there's a real, at some point, there's going to be a need for life strategy ETFs, life cycle ETFs, age-based ETFs, balanced fund ETFs. These are the direct products that are sold to consumers. Like, for instance, Vanguard has this product called Life Strategy Funds, which have billions of dollars in them. They're just balanced funds of other index funds that are in there. There's no ETF equivalent to that. But boy, there should be. There really should. I think iShare might have something, and they've got $1 billion in their one fund. So my point is that the products need to be developed just directly for the retail marketplace. We're not seeing it yet, but it's coming. I think it will eventually come.
So in our last 2 minutes here, just a final thought to wrap up. This is a conference about disruption, innovative disruption, or as Kathy Wood puts, creative destruction. Either way, we're trying to see what can be done differently and what's coming next. So when you think about the what's next for ETFs, what's next for asset management industry, like you, Reggie, specifically, you were talking about a digital currency ETF. You were talking about, reaching the unbanked and a whole new demographic. Rick, the target date, like the balanced portfolios, and all these things. What do you think will be the next big aha moment here? From your crystal balls, what should we be excited about as we look in, let's think short term, like 12 to 24 months, maybe. Anybody who wants to start, take it away.
Go ahead, Anita.
I'll start quickly. Well, I do think in 12 to 24 months, the next frontier is getting ETFs, either a Bitcoin ETF and or tokenizing ETFs and much, much more. It's really, like you said, Cinthia, reaching the unbanked, reaching a new channel, right? Retail right now is a new channel. Blockchain is going to be the next new channel. And to your point, reaching the unbanked on there and providing the asset management tools on the blockchain for those currencies as the same as you have for the traditional currencies.
Reggie?
I just think we'll see more growth by active managers coming into space. So I think the marketplace will be surprised about the number of active managers that will move away from the open and mutual fund complexes solely and launching ETFs. And then the growth of AUM because of it. So I think in the next 12 months, that's the story, in my opinion. Whether or not we see fractionalization using tokens, I think some of the fraud needs to be worked out of the system for that takes hold, and concerns around that. But it's definitely a conversation point. And then really it just comes down to the utilization of the advisor. I think you'll see some changes in the advisor community because young people are getting inheritances and they want to have direct access. And I think you'll see some advances there, in my opinion.
Awesome. Rick, final word.
Yeah, I'm going to agree with Reggie in the short term. It's all about active ETFs. I think that there's a lot of companies that need to launch active ETFs. And I think that, again, we talked about the tax issue of holding back active ETFs, active funds that could be launched in an ETF form, make it much more tax efficient. So I think active ETFs are really the next big thing, if you will, by a lot more companies. I think in the very long term, I'm talking about my great-grandkids, maybe. I already have grandchildren, so my great-grandchildren. We're talking about coins, the coin-based model where the next vessel, if you will, to deliver a portfolio could in fact be a S&P 500 coin. I think the first treasury coin is actually trading, that is backed by treasuries. So S&P 500 coin, MSCI coins, I mean, you could do it at coin-based, and that might even be less expensive than doing it through ETFs or certainly through mutual funds. So, but that's way down the road. A lot, as Reggie said, a lot of regulatory issue hurdles got to get over first. But that's what I think. Active ETFs are going to be the next big thing.
Awesome. Well, I wanted to thank you guys for this awesome conversation, Anita, Rick, Reggie, and thanks you folks for joining us. Feel free to reach out to the panelists if you have any follow-up questions, and let's go disrupt something. Have a great day, everybody.
All right.
Take care.
Bye.